So Larry, we were down in Washington DC yesterday to enjoy the sunny weather and the cherry blossoms, but we had other agendas in mind. Tell us a little bit about, tell the folks a little bit about why we went down to DC and what was the purpose of our visit.
Well, we went down to DC because we were invited by the Treasury Department to really talk about different market structure issues, different issues and concerns we had with clearing and what's happening with some of the Dodd-Frank regulation, as well as what's happening with dark pools and electronic trading. And they're actually very interested in some of the issues around electronic trading.
So we met with Mary Miller, and we had a room full of around 12 or so other officials. What did you get out of the meeting? What did you think they were looking at and most concerned about?
I think they were just trying to hear our views. We talked with Mary Miller. She's the Undersecretary of Domestic Finance for the US Treasury, as well as like a dozen other people, as you said. And we had an interesting discussion. I think, my agenda was really looking at a number of things. The first things was clearing risk and the whole issue that, we need to really ensure that now that the clearinghouses are SIFIs, systemically important financial institutions, and they're tied to the Federal Reserve, and others outside are tied to clearinghouses. We just want to make sure that they know that it's imperative to manage risk properly in these organizations, and that since they're backed by the taxpayer, we don't want any types of incentives to basically reduce the risk thresholds, to reduce the cost, to try to gather, and capture market share in business, and create greater systemic risk.
And they seem pretty receptive to that. I think one of the comments was maybe a sort of an interim period of margining treatment. I even heard a 10-day VAR being thrown out as opposed to a 5-day VAR or a 1-day VAR.
Yeah, I think that we just need to be careful that we don't carve some of these risk measures in stone before we really understand what's it actually going to cost to resolve a failed client. Now, we may only need 1-day VAR, and portfolio margining may be fine, and really the liquidity either in the swap side or the swap's future side, or the uncollateralized or uncleared swap side is all fine, and there's no problems. But I think what we want to try to do is ensure that we have adequate people looking at this issue and possibly saying, hey, look, let's gather 6 months of data and get some loss figures at maybe a little bit higher capital rates, and then if it's okay, lower the margin rates or enable other types of margin efficiencies. The last thing you want to do is not have enough margin on hand to resolve an issue, and then having either the institutions backstop this, which means that possibly you wind up with the same contagion that you had before, because all of a sudden now the institutions have to pay into the clearing fund in an unlimited way, which then taps out their capital, which then creates contagion, or that the taxpayer is going to need to step in and bail this whole thing out, and then we're back to instead of the big banks failing, got clearinghouses failing, and we have a TARP for clearinghouses.
High frequency trading in treasuries came up too.
Absolutely, they since they're the actual issuer of treasuries, they were very interested in the whole idea of HFT for treasuries and where that is going to go. Now, we talk with them. What our view is that there's increasing electronic trading in treasuries, but we don't see that being a real high frequency type play, because to a certain extent, outside of the benchmarks, they're not necessarily as liquid, the market's not as fragmented, that there will be increasingly electronic trading, but not necessarily this millisecond type back and forth kind of thing. Mostly because a lot of the HFT guys just don't have the capital base and the ability to hold risk for long periods of time, which may be needed in that kind of environment.
Cool. Okay.
So after, or actually before Treasury, we had a little jaunt over to the CFTC. We saw Commissioner O'Malia, the newer Commissioner Wetjen, had an interesting talk. So
yeah,
why don't you talk a little bit about that?
Well, I really enjoyed having two commissioners from the Democratic side and the Republican side both at the same table in the same meeting, and their advisors as well. That said, I think the thing I really got out of it was a high degree of frustration from both sides.
I would agree with that.
In terms of trying to get the SEF rules out, and obviously we've known that in the industry for about 2 years now.
Right. How long have we been waiting? About 2 years.
About 2 years, right? So so I think that there is frustration there. One of the things that we wanted to really talk about was what we'd been understanding in terms of this migration from over-the-counter to the world of electronic trading or SEF trading or transparent trading within SEFs, and also some of the futurization elements. But one of the things we've been thinking about a lot and talking about is this issue around how OTC markets facilitate size discovery versus under the transparent trading mandate, the emphasis being on price discovery. And so we wanted to talk to them a little bit about what that introduction of that dynamic might do in the over-the-counter market, and we wanted to sort of get a sense of how cognizant of that change they were, that this would be less of a size market and more of a price market, and what would be the final outcome of that change.
I think they understood a little of it. I'm not sure they fully understood the issue and what are the challenges. So why don't you tell some of the forum listeners what do you think the issue is as we move from kind of more of a size discovery where people, they care about price, but they're not really concerned as much about price. They're really more concerned about size.
Right.
To when you start migrating to kind of an order-driven market and possibly an agency-driven market where price becomes the primary issue.
Well, the obvious vanilla takeaway from it is that ticket size is reduced, but I think it's about more than that. What I hadn't fully understood before was how market structure and over-the-counter trading was really more of a kind of a trickle-down funneled effect, that one marketplace predicated the existence of another type of environment for trading. So the SEF mandate kind of simultaneously introduces a variety of protocols where everyone can get access to all marketplaces and enjoy variety of but the more I understand market structure in terms of this migration process, I understand the relationship that discovering size leads to request for quote, where you can get size and price determined off of the midpoint that's understood well in the interdealer broker market. And I think that was really to understand that one market function was the derivative of another type of market that existed, as opposed to saying, okay, so it's a free for all. Yeah, free for all. We can all trade, and there's all these and it's going to be happy-go-lucky. I don't really understand that necessarily is going to play out that way.
Yeah, and the issue becomes is, if this all for one, if this market where everyone can interact with everyone actually breaks apart the wholesale market to a point where liquidity providers don't feel comfortable quoting in size.
Yep.
And what does that actually mean? And how does that break apart the ability to really provide prices for some of the bigger players, the bigger certainly mutual fund complexes and asset managers, but also the larger companies and to a certain extent governments who are trying to manage risk on a real macro scale.
So we saw the CFTC. We saw Treasury, and then on our way out, we bumped into the SEC too. So
yeah, hanging out in and actually a 90-degree Union Station, we bumped into some of our friends at the SEC, which was interesting. It was good to see those guys.
Yeah, so I think all in, we considered it a pretty successful trip.
Absolutely, very successful trip.
Well, on that note, we'll wrap it up. My name's Will Rhode, Director of Fixed Income Research at Tabb Group, and I've been joined today by Larry Tabb, CEO of Tabb Group. Thanks for joining us.